Yeah! FOMC, baby! We'll start in just a moment or two. Happy Fed Day. Steamby.
European stocks close mixed as investors react to earnings, economic data. Google to invest $6 billion in southern India data center, sources say.
Federal Reserve set to leave interest rates stable as mounting uncertainty clouds economic outlook.
Fed preview holding steady amid tariff uncertainty and political pressure.
Ripple price forecast. XRP defends $3 support ahead of U.S. government cryptocurrency policy report. Dow Jones Industrial Average treads water ahead of Fed interest rate decision. Apple Inc. AAPL earnings. Preview. Navigating growth, tariffs, and AI innovation. Major European indices close mostly higher. Gold lower with the higher U.S. dollar. Gold price forecast, gold U.S. dollar pierces the $3,300 mark as the Fed looms. Australian dollar, U.S. dollar price forecast, bearish momentum picks up pace. What happened to our music? Hey, so we're waiting for the Fed to announce they're not going to do anything. And then we got to wait for the press conference. Doesn't get better than that. Eight minutes. Last opportunity to get your drink or your lunch, get your soda or your coffee or your tea, your dirty chai. Yeah, 5 minutes. 5 minutes to the Fed announcing their decision to do nothing. I have CNBC. I turned the sound on so I can hear it behind me. What does it mean, Mahai? Thank you, Richard. Two minutes. President Trump. Powell will probably not cut rates today. Oh, well. Well, thank you. It's a bit of a stretch. Yeah, there's no chance. I mean, we already have it documented for months that they were not going to raise today. Right. No chance. Well, the way I look at it is they already told us. No, it's live. It's not delayed. It's delayed on YouTube, but not delayed inside the website. 58 seconds. "25 seconds. A minute. 15 seconds. 9, 8, 7, 6, 5, 4, 4. All right, so let's see. Are they going to do anything? Probably not. I think it's even. There you go. No cut, no pause. It's pause. You got the news from me faster than CNBC and Bloomberg, both going on behind me. So, and the dude trying to get Powell's job was the one that said cut. But I don't like a backstabber like that. So, in a half an hour, we will have a press conference. Maybe we can learn something there. But I'll show you, we've known about this for a very, very long time. Database is slow, sorry. Thank you. Go to fundamentals. Go to central banks. Go to the dollar. And there we go. So September is on the table. So now we got to wait. We'll see. Well, Waller is a backstabber, Frank. So I don't know if he actually thinks that or if he just wants Powell's job and is willing to do anything to get it. Well, that's not cool, man. That's not cool. Bowman? Yeah. So nonetheless, there's no surprise. Let's check the market. Okay, another good day. Treasuries, look at that. Oil 71. Holy smoke. Gold down, S&P 500 flat. So maybe things are moving now. Maybe. Yes, instead of doing that, I could just add the insert indicators, custom price action pivot points. Let me just kind of mess around with this. 24. I know it's not a fib or a fib number. And then you go to the hourly. So we're right in a sell zone. If it's not going to go up, now's the time for it to go down. You know what I'm talking about? Mixed. Options market. Volatility, long-term yields, dollar, stock market, yen, gold, short-term yields. Nothing is going on right now. Let's take a look here. Let's get rid of the outlier. Looks like most things are doing as expected. Okay, so everything here is up, and that's good. Everything here is down, and that's good. Most things are doing as expected. Pound strong today because you can see that pound stronger. Okay, so we're right on schedule. It says one in September and one in December is what it says. You're reading that? Yeah, welcome back to summer trading for sure. But everything is right as rain. Everything is the same as remember we got this out of the dot plot. So there's no surprise at all. And it's not a guess, it's just what's in the dot plot. So one thing to pay attention to is the change, let's say. You're not going to see it yet, but tomorrow there's going to be a lot of articles written about today's news, whether it's GDP or FOMC, right? Or earnings. So like Visa reported recently, and a lot of articles have been written about that. It looks like positive. Dollar strength, pound strength. So the fast and furious version of this is just click on currencies. Neutral, dollar strong, dollar weak. What? Well, why? 21 articles on 4 different websites think favorably about Aussie dollar. I mean, what's the play with that? Like a deal done with China, maybe? I don't know. But this is what the media is written. It doesn't make it real or right. But quite a recovery there. So Microsoft is tonight and Meta's tonight. All right, cool. "85 articles about Microsoft and it's neutral." So we read 85 articles on 27 websites this week. Can you imagine that? So if you read articles about Microsoft on Barron's, Benzinga, Bloomberg, Business Insider, Business Wire, CNBC, Forbes, Investor Business Daily, Market Watch, Market Beat, Reuters, Schwab, TechCrunch, Seeking Alpha, The Motley Fool, This Street, The Wall Street Journal, so on and so forth. If you look at all the articles being written, it's a mixed bag. Isn't that cool to be able to do that? 85 articles, 26 websites, neutral. Good to know, right? Yeah, that makes sense, Frank. So one of the things we're working on right now, and I mean like right now, is that we are tapping directly into the CME Group's database to gather all the data that's used to build this chart, and we're going to build our own version. And so ideally we can make it look very similar. I'm not sure if I can, but we'll do what we can with the data. But we might be able to do things that is not presented here because we're just tapping into the database. So hopefully very soon you'll be able to every day very easily inside of TRADARS track the probability of a rate cut. Okay, so like for example, 63.1% chance of a Fed cut in September. 63.1. Yeah. Now, so that you're like, that's cool. You can build that in, Wayne. That's really nice. But, you know, I could just go to this website every day. Well, Trader Ward, right? Peter, why would you want to know the probability of the Fed cutting in the past? But I'm not sure where you're going with that. But that's all, right? So that's what I'm going to do, David. But to address this issue of like, well, we already have the Fed Watch tool. Why would you need to do it? Well, I'm going to do that calculation for every major central bank in the world. So, anyways, I'm not sure what can be done. We have a working model with their sample data, but they still haven't released the live data to us yet. So, well, I'm hoping it'll be done next week, David. So, anyways, so that's where we are. And if you look at this historical probabilities, a month ago, a cut was 75% priced in. A week ago, 59.9. Yesterday, 63. And now, bada bing, bada boom. So we've dropped from 75 to 63 in the last 30 days. So I believe I have this data. So we will have that. We will have this. We will have this data because you need that for the calculations. Okay. But the thing is, it's not easy. So it's nice that the CME group does this for us, but it's not easy. Does anyone have this data for like the Kiwi dollar? No? Well, you will probably next week. And be able to track it near real time, meaning, let's say several times a day, we update the probability. Instead of every day, every week, every month, it'll be, a few times a day, maybe hourly. Most of the time, it won't be that relevant, but you'll have the data. Okay. So today there was a 97.9% chance the Fed would hold. Yeah, Don says 63, like it's almost 2/3 think there's a cut. Yeah. Now keep in mind they could be wrong. It's just people negotiating prices in contracts. It's implied. But they can be wrong. Because this is not a survey of what the Fed thinks. So today, two people voted to cut. One of them is for sure just simply playing politics and may not have put any thought into it at all, or maybe that truly is the opinion. But two out of it, two is not very many people out of the whole board. So is it really 63? In this case, it's 62 is closer to an accurate number than 63 because this is two cuts. So, and they're probably wrong. So it's really like, okay, so there's a high probability of a cut in September, but that's just what people think. You have to ask the Fed. Now, the current, the current dot plot doesn't say two cuts. What does it say? Does anybody know? 1.5 cuts. Haha. So, yeah, okay. Fed back when they released the last dot plot was 50-50 on this. So yeah, maybe this is fairly accurate, but we're deriving this from price. Doesn't make it correct. Okay. Cut, 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 cut. You ready? Okay. Pause, cut, pause, cut, pause, cut, pause, cut. Okay. August, September. Boom! There's a cut right there. So it'd be nice to get some of this stuff in here, huh? I'm just eyeballing all this. What do I want? What do I don't want? It's not changing. Wow, slow. All right, so there's our dot plot. 25, 26, 27, 28. So a 3-year bull run in bonds. Wowzer, huh? So there's the thing over time. A month ago, we were at 75, and then it dropped, and then has risen back up. So nice. Then you can go out to October, and then December. What's the probability that we're going to be here? Some people think multiple cuts until there, but the Fed doesn't, and that's the weird part. Sounds like a 3-year bull run, yeah. But again, these things we already know. Cool. So what's that time? We got about 6 minutes. I guess let me get the press conference up and running. So why don't I? You know what? Hang on. I want to show you something. Just where is it? Guess it's this one. I want to show you something. That's not the one. Yeah, so here's one. Let me show you. The new email service, the mobile service of TRADARS. TRADARS mobile service, TMS. How'd you like an email like this? Isn't that cool? So this is to get you ready right before the markets open. You can very quickly see these things are becoming more bullish and these things are becoming more bearish. So you could start the day where you're like, sell Aussie, sell Aussie, sell Aussie, buy Kiwi, so on and so forth. US dollar strong. And those are changes in the scores. Do we have this still up? Let's go here. So what we're doing is several times a day, the algo is going to check the database right before the market opens and then read this and tell you what has just changed recently. What do you guys think about that? Okay, not bad, right? Okay, this one came out 3 hours ago, and it comes out immediately on the change. Bitcoin became strong bull, and pound Swissy became a strong bear. Both of them, both the changes came from technical trends. Isn't that nice? So now you could just get that on your phone and go, oh, snap! Cool, right? Okay, time to get ready. All right, here we go. Thank you, Federal Reserve. Steampy. That's the music they decided on. I love how they have a backdrop and then they're like, don't cover the door. You guys excited? Yeah, baby, yeah. Whoa. There's a delay. YouTube's delayed.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market
All right,
is
I just
at or near
unplugged something
maximum
by
employment.
accident.
Inflation has been running somewhat above our 2% longer run objective.
I think it's my mouse.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about
That's
monetary
YouTube.
policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE
All right,
prices
well, that's
rose
YouTube,
2.5%
so
over
let
the
me-
12 months ending in June.
Let me bring up a
And
different
that,
source.
excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the
I don't think that helps
data,
either.
the evolving outlook,
About
and the
the same.
balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more
Is
persistent.
that any better?
And that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem.
Awesome,
For the time
Santiago.
being, we're well positioned to learn more
Can you guys hear this better?
about the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary
Let me
policy
try
framework.
Bloomberg.
We focused on potential revisions to our statement on
Each stream has a different volume, right?
the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions
Everything's
affect
at
families,
100%
families, and
volume.
businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly
I
restrictive.
can turn my mic down.
Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market is solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil. Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic.
Didn't know I had that one running. Sorry.
Half last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't. That you're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one, so I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, you know, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Yeah. Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation, sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate, kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just